Hi guys, so let's now take a look at LEDCs and globalization. So LEDCs do benefit enormously from the process of globalization and really integrating themselves into the global economy. Of course, however, there are downsides. Alright, so let's take a look at these in detail here. So number one, well, it means that an economy can exploit its comparative advantage. So whatever a given economy can actually export at lowest opportunity cost, it will be able to do so, and that will be good for the global economy. It will enable that specialization, the development of economies of scale, and it will really help to actually boost export earnings for that given country. Now, those comparative advantages will vary depending upon where in the world that country is, what sort of climate, what sort of conditions will be apparent in that economy, and their stage of development, of course. Because don't forget, comparative advantages, well, they change over time. So you've got to be aware that countries need to make sure that they continually adapt and adjust and always move into that next high value added sector where they can exploit that comparative advantage. Right, so number two, okay, here exploit low cost resources. Well, of course, in relation to both these points, China has just been such a wonderful example of the primary beneficiary, really, of globalization. It's exploited its comparative advantage in manufacturing, first in textile manufacturing and now in consumer goods. Okay, now it's also been able to exploit its low-cost labour resources and the plentiful pool of labour that has been available because of the sheer size of the Chinese economy. Okay, don't forget, within resources we also see land and capital. Okay, so there's two other areas to actually focus on. It may be that a particular country has particular resource endowments. For instance, Venezuela, much renowned for the actual sheer quantities of oil they have in their economy. Okay, number three, develop and diversify the economy. So it means that the economy can prosper, it can become richer, and those export earnings can actually be used to diversify into, as we said, higher value added sectors, and that is good for economic development in these economies. Okay, moreover, you can also attract inward foreign direct investment. As you attract that foreign direct investment, in the same way that we've seen this in China, it enables human and technology transfers to be facilitated. So human capital develops because they now begin to actually experience Western management systems, which are very, very efficient, of course, and that helps to develop their expertise in terms of management, leadership, and operational organisation. Okay, but further to that, there are technology transfers through actually benefiting from the technology that those firms may integrate within their operations facilities in LEDCs. Okay, number five, well, the principle here of increased export revenues, of course. If you are exporting more goods, that will help to boost your aggregate demand, of course. As net exports increases, that increase your aggregate demand, and economic growth may consequently increase significantly, and that may help to boost living standards quite considerably in the economy. Okay, downsides, however. Well, number one here is primary product dependency. So some economies can become overly dependent upon their primary products, and that can be a real issue. This, of course, leads to, as the Prebisch-Singer hypothesis tells us, declining terms of trade in the long run, because these primary products generally have very weak income elasticities of demand. If you take oil as an example, okay, and of course consider that petrol is derived from oil, so if your income increases, how much more petrol do you demand? Well, perhaps a little bit for another foreign holiday, but thereafter, it's not going to increase significantly. So compare that with consumer goods that these countries will be importing. Well, we can see that there will be declining terms of trade in the long run. Okay, so that will mean that more goods need to be sent abroad to actually maintain that same quantity of imported goods from overseas countries. Okay, number 2, danger of Dutch disease. Right, so if these primary products are actually discovered, or that there is just greater extraction and greater depletion of those resources because of improved mining capabilities and so on, then there really is a risk of the currency appreciating, and as the currency appreciates because of all the inward investment that is taking place into that given LEDC, then that can render other industries less competitive, because you're dealing with that situation as spiced then. Strong pound, imports cheap, exports dear. So as your other export sectors really begin to struggle and suffer, then ultimately you may end up losing all competitiveness. Okay, so that really can pose a problem, and we've seen that most recently in Brazil, of course. Okay, then we've got negative externalities. So we mentioned resource depletion or resource extraction, and related to that is resource depletion, of course, where no of those actual resources are left. Okay, but then there's also environmental degradation. If you think about the actual impacts of tourism, as tourists come to a given country, yes, they may well enjoy it, but they may cause a lot of pollution and generate more of those negative externalities. Okay, then we've got tariff escalation. Now, this tariff escalation is an interesting one because it can reinforce this issue of primary product dependency. So, for instance, if you take raw coffee beans, okay, or raw sugar, raw cocoa, those raw products are not actually subject to tariffs. But when they are refined or roasted and turned into a finished good, and that value is added, then there is something like a 10% tariff placed on those goods. And that tariff escalation can therefore encourage these countries to remain primary product dependent. A classic example we've looked at in my class has been the fact that Germany is the largest coffee exporter in the world, and it is simply because of the EU's tariff policies, which really penalise African countries who want to export roasted coffee to the EU. Well, they have to pay a hefty tariff to do so. So that roasting process tends to take place in Germany. Okay, then we've got hot money capital flows as a final point here. So the fact is that when there is short-term capital inflows, as we saw in the Asian financial crisis, it can really lead to massive imbalances within the economy. It can lead to big capital account surpluses and commensurate current account deficits. Okay, so that really can pose big problems, because that money may be withdrawn very quickly as a direct result of that. Okay, so what does this all mean overall for LEDCs? Well, perhaps the best way to actually manage this sort of scenario is in a gradual process, much as we have seen with China over the last 30 years in their economic development and the way in which they've integrated into the global economy. They've remained insulated from hot money capital flows because of the capital controls they actually have in place on their currency. So perhaps that may actually be a model for many LEDCs to actually follow in terms of integrating themselves into a globalized world. But certainly there are plenty of benefits that they can really enjoy. Okay, and that rampant economic growth can be a big winner. Right, thanks everyone.